Okay, Josh, you're going to drive for us here a bit and let folks in as they join us, and we're going to get started. Do that. Okay, so I got the remote, Josh. You just let people in and let me know if there's questions, and we'll get rocking and rolling from here. So, understanding credit and the home buying process. That is our subject this week. And we're going to be doing these seminars, a lot to cover. Right now is what's going to drive the first quarter of 2023. So, we want to make sure that we're getting off on a running start. So, we're going to start off this week. We're doing understanding credit and the home buying process. 2 weeks, we're going to be working on a business plan. And 2 weeks after that, we're going to do a marketing plan. And I think probably 2 or 3 weeks after that, whatever the first Thursday is that we're back to work, we're going to do video marketing for realtors. So we're got a full schedule coming up. And then we hope that you'll be able to join us. If you go to rsrseminar.com, you'll be able to see all of the upcoming seminars. You can register for all of them or one of them or whatever you want. But today we're going to get started on understanding credit and the home buying process. If you have questions, put them in chat. Josh is going to be monitoring those for us, and we'll see what we can get for everybody. So, whoops, let me get back if I can. Maybe I can't. Our agenda today: history of credit, credit scoring model, consumer score versus mortgage score, reading a credit report, applying for credit, and credit and your mortgage. Those of you that haven't seen some of the seminars I've done in the past, I helped the first family I helped with a loan was in 1983. And yes, I was still in college at the time, and it was an immigrant family, very, very unique situation. And we started back in 83. I've been looking at credit reports for a very, very long time. And, you know, when we look at the history of credit reports, the first credit reports actually, if you want to look at them, if I can get this thing to pop up on the screen, tells us that in 1956, no, I wasn't around then, is when FICO created the first credit scoring model. And FICO Fair Isaac Credit is the standard. And you know, they've been trying to change it and get other models to be available for this. Haven't had a whole lot of success in it. But like I say, going back 1956, Fair Isaac Corporation, they created the first scoring model. It was the Wild West at that time. They could put whatever they wanted on there, and yeah, no one really had any clue as to what was going on. So in 1970, the Fair Credit Reporting Act was created, updated in 2003, sets all kinds of rules for reporting credit. And one of the things that a lot of folks don't understand is that nothing at all, nothing has to be on your credit report. The 3 rules that came about based on the 1970 Fair Credit Reporting Act and updated in 2003 was basically anything that is on the credit report must be complete, it must be accurate, and it must be verifiable. If it misses on any one of those, the next step is it must be removed. So you got to realize that that's a big issue right there, the removal part. That's why when we talk about the ability of correcting a credit report, it's not that difficult because we're just using the law. So think about this one. And one of the ones, we'll talk about what can be removed and what can't be removed in a little bit. But anything that's not complete. So if a credit card issuer, say a Visa, if you look at your Visa card, that's a 16-digit credit card number. If that complete 16-digit account number is not on your credit report, then that's not complete. If it's not complete, it must be removed or it must be corrected. Similarly, if you've got one agency saying that you've had your American Express card since 2019, and another agency says you had that same exact card, same account number since 2017, they're not accurate. which one isn't accurate? We don't know. So it's got to be verified. If they don't verify it, it has to be removed. You don't want to, you want to be careful of removing things because certain things are good things and you don't want those removed. Maybe you just want it corrected. 1974, the Equal Credit Opportunity Act basically says we can't discriminate. And I don't know if the person is on here right now, but I had somebody, ironically enough, send me a note when I had sent the invitations for this. They said, will you allow African Americans to be on your seminar? And I almost had to take a big step backwards and say, why would you even ask that? You know, obviously I don't travel in the same circle. I haven't seen that discrimination, but you know, no, number one, it's against the law. And number two, it's just not right. So we don't discriminate against anybody. But 1974, that's the Equal Credit Opportunity Act came about. And it basically says that you can't discriminate. So the Fair Credit Reporting Act creates laws provide the following: the right to see your credit file, the right to receive score from a lender, the right to dispute information. Information must be kept private, and the right to opt out of information being sold or shared. Big issues right there. So if you notice, when you apply for a mortgage loan and we pull the credit, right after that happens, you're going to get within a week or so, maybe less, a copy of what was pulled. It'll come right from the credit reporting agency that we use. And it's generally the first 2 pages of each report. It doesn't send the entire report. You do have the ability of getting that. So we send that out automatically. If there are errors on your report, you have the right to dispute that information. I will share with you that disputing the information on the online form is basically just shooting yourself in the foot. So don't ever use the online form for anything legitimate. If you're disputing your name, that maybe they've got your name wrong, that you can use the online form for. But anything of consequence on any of your trade lines or government reporting, don't do that with the online form, because part of that basically says that you're giving up your rights. I can tell you this on my report, I fight it all the time because one of the credit cards that I have has my name incorrect. So they truncated it. What they really did is they must have bought a list somewhere. So my name is Ronald Ivan Siegel. At some point in time, someplace they had my name Siegel, Ronald Ivan, and they just cut off the Ivan and made it IV. So for that particular credit trade line, my name is Ronald Siegel IV. And I correct it, and then they send it back in again, and they change it back, and then I have to correct it again. And what that ends up doing is that over time, even though they say it doesn't have effect on your scores, I've watched where it does affect my score when they change my name. So I'm watching mine all the time. I actually have an app on my phone that shows me every time a change happens with my scores or my wife's scores. So I'm watching those all the time, and I'll manipulate them so that I can share that information with you and for the radio audience that we talk to every day. So I'll let the utilization rates change. I'll let that particular the name change, and I can see what that happens to the score all the time. Again, even though we've all heard about the bureaus having these massive information leaks, the law says is your information must be kept private. So however good they do on that one. And the right to opt out of information being sold and shared. So I'm going to share with you right now, I recommend every person go to optoutprescreen.com. Now, if you like getting junk mail, if you like getting all kinds of credit card solicitations, if you like getting phone calls in the middle of dinner, don't do this. But if you want to get rid of all that stuff and you don't want your information being sold to everybody under the sun, optoutprescreen.com. And that's how you stop your information from being sold. And be aware, that's how the bureaus make their money, is by selling your information. So they really think, when was the last time you paid a credit bureau? Right? As a lender, we pay them. As your credit card companies, they pay them. If you're looking to buy a car, they're paying them. But the consumer doesn't pay them. They make their money by selling your information. So what is a credit score? And we'll get to, in a minute, we'll get to a lot of, the difference between a FICO score and a FACO score. But basically, a credit score is a 3-digit number used by lenders to evaluate the risk associated with lending money. Mortgage lenders use the FICO scoring model. Lower score is higher risk. I haven't been able to verify this, but I had been told at one point in time that the number you get on your credit report, on your credit score, is loosely the percentage of likelihood is of you paying your bills in the next 90 days. So if you were to have an 800 FICO score, they basically say that's an 80% chance you're going to be on time with all your bills over the next 90 days. I've heard that several times. Fair Isaac does not confirm or deny anything. So even when we talk about what the algorithm that they use, they never tell anybody exactly what their algorithm is. But again, lower score, it's not like golf. Low score doesn't win. So the lower score is the higher the risk of default. So credit report, what is a credit report? We're going to go into that one. So if you haven't seen the details of a credit report, it's a very detailed breakdown of the credit history prepared by the credit bureau. It has all of your information. It has detailed credit lines. It has public records. It has employment information and your address history. So again, if you've got a lot of incorrect addresses, that shows instability. So it will have an effect on scores, and it'll also have an effect on some of the people that maybe you're authorizing to pull your credit scores. So if you want to make sure that's clean. Credit bureau. So what is the credit bureau? There's a lot of them, but the main ones are Equifax, Experian, and TransUnion. Credit bureau is also known as the Credit Reporting Agency, the CRA. They collect and research individual credit information and put it into a report. Then the CRA assigns a credit score based on their credit scoring model. So you can get a credit score or you can have a FICO score. Two different things, but you can have those. So the credit bureau is also known as credit reporting agencies. There's 3 different independent companies from one another. They don't always all have the same information, so that's why you'll have different scores from them. Creditor may choose which credit authorizations, if any, to report their debts to. So as a lender, any lender reports to the bureaus. They pay to report to the bureaus. And they can say, okay, I'm going to report to all 3. I'm going to report to only 1, or I'm going to report to 2, or I'm going to report to none. That's why you see some places where you might have a debt that doesn't show up at all. And you're saying, well, I've been paying that company or that card or that individual for years, yet it's never shown up anywhere. So sometimes if they don't pay to submit the information, it doesn't show up. Because each creditor can choose which bureaus to report to, the credit scores will vary between bureaus due to different information being reported and slightly different scoring algorithms being used. You would think that they'd all be the same. The scoring model. This is another big item of contention that a lot of people don't understand. And again, I'll say it, a lot of people don't want to. The credit bureaus make more money by suppressing your score. The lower your score is, the more money that they make. So guess what they want to do? So part of that has to do with it, and what do some of the lenders even do? So that as a lender, lenders are required by the government-sponsored entities, that'd be Freddie Mac and Fannie Mae, and then the government entities themselves, FHA, USDA, and VA, to use FICO scores. And they actually give the minimum of which model to use. So mortgage lenders only use FICO scoring models. Equifax FICO scoring models equal to Beacon 5. Experian uses model FICO 2. TransUnion uses FICO Classic 04. Now, here's the fun part, is that we're basically at FICO, I think 10 or 10T are the FICO models that we're at right now. So think about it this way. Right now, I think, and I don't use it, well, I'll go with my phone. So if I look at my iPhone, we're on iOS 16. If I had my phone and we were using iOS 9, That would be the same as using an older model of the Equifax or the Experian scores. Things that are new and improvements aren't filtered in. And that's where these changes come from. So when you hear that there's been a requirement to say you can't report medical for 6 months, and you have to give the consumer an opportunity to correct it. Well, that's a newer item that's part of the scoring models or mandates. But if we haven't started using that particular scoring model, it's not getting filtered in. So even though the mandate is there, it's in the FICO scoring system, but not being used. So who cares? So who is supplying the information to the credit bureaus? I touched on that a little bit. So creditor or lender supplies the credit bureaus, CRAs, with information typically on a monthly basis. They pay a fee to report each trade line, so they're the CRA's true clients, not the consumer. That's a big issue right there, right? So if Bank of America has a credit card, or a Visa has a credit card, or you get your Home Depot card, they have to pay the bureaus to get their information into the bureau. You're not paying them. Who are they going to be beholden to? They're going to be beholden to the one that's their customer. So the basis of what happens is the lender sends their information in to Experian, TransUnion, or Equifax, or any one or all of them. They run it through the model. Then they put together a tri-merge report, or you can order a single, but tri-merge is what we use in the mortgage world. So you have a tri-merge report, and the tri-merge basically has all 3 bureaus on there and tells us all the information that we're looking for to get the report to you. So then they are the credit vendor. So you've got a lender that's sending information to the bureaus, paying them. Then you've got the credit vendor. That's who we have to pay in order to get your reports. They've got it made. They have people paying to send them information and then paying to get the information. And they just sit there in the middle with these massive computers and claim that they're going to keep the information accurate and confidential. Does anybody believe that? So credit vendor is a company who buys information from the 3 bureaus. That would be your lenders, compiles and sells the information to banks and lenders in the form of a tri-merge report. A credit vendor can also provide services like Credit Expert and Rapid Rescores. Those are a couple of different services that what they do is they look at your credit report, run it through the service, and say, well, if you were to use, say, they might come back and they'll say, if you have $3,000 and use it appropriately, that $3,000 will increase your credit score by 5 points or 20 points or 70 points or whatever their number might be. And then Rapid Rescore is basically where we as a lender can go in there and say, okay, well, my client just did this. We'd like to get it rapid rescored and get a new report with those rescores so we can use the higher scores to determine what kind of pricing we can offer on any kind of a loan. Credit vendors, basically CoreLogic, Credco, Kroll, Cisco does it, Exactus. A lot of different companies use a lot of different services to buy these. Basically, it's the same as like a title company, right? So you can go to lawyers, you can go to First American, or you can go to WFG. They're providers of that title. This is very similar. So you've got Credco or Cisco, any of those. They're the people that a lender will go and buy that from. So what is the FICO scoring credit model? FICO scores. Now, I shouldn't, because I didn't get to this before. There are what I call FACO scores or credit scores. So FACO scores or credit scores, that's going to be your Credit Karma, Credit Sesame. Anytime you see it where it just says credit score, you're generally going to be you're not talking FICO. That's going to be something different. Those run on a completely different range. So where your FICO score is from 300 to 850, the credit scores will range anywhere from like 300 to 900. Some of them are 250 to 900. I've seen a difference, even though they try to mirror FICO, I've seen differences as much as 100 points in what those are. So to generate a score, the credit reporting agency applies the mathematical algorithm or scoring model to the information in the credit report being used. Not all items are weighed equally, like you can see on the chart there on the right. And let's go over those just a little bit so you can understand what these are. And we've got a whole series that we've done from radio show programs where we've actually pulled those out. And if you want the series, it goes into depth on all of these different things of what affects your FICO score. And just let us know, we can send that to you. Payment history is 35%. So that's going to be your late payments, your collections, lenders priority, record of repayment.
Hey, Ron.
Yep.
Can't see the slideshow.
Can't see the slideshow. Let's see what happened here. Do you see it now?
There we go. That's good.
Okay, are we back on?
We are back on.
Cool. See if I can move these names. Let's see if I can move. Okay, so again, payment history, 35% is from late payments, items and collections, lenders priority passed, record of repayment. 30% is utilization. This is a biggie. This is the one you can control all of these, but the utilization, it's 30% of your score. So think of this, you control both of these items, right? The way you pay your bills and the utilization. That's 65% of your score. So that's a massive amount. When you think that your score is a 500-point score, 300 of your points are basically right here. So, you can control this. So make sure you're watching these. And again, we've put this onto a methodology to show you how to pay your credit card bills the right way. rsrccpayment.com. rsrccpayment.com. And I did about an 8-minute video showing you how to pay your credit card bills the right way to maximize your FICO score. But again, that's the balances of your scores, of your credit cards. So think of it this way. If you've got a credit card with $1,000 limit and you've got 900 used, that's 90% utilization. That is not good from your FICO scoring purposes. You want to keep that below 30% is really where you want to be on that. Well, let's see why we're not. Okay, there we are. Length of history, 15%. How long the accounts have been opened and when the accounts were last used. So again, don't close good accounts. You can close bad accounts where you've got lates and things like that because they're gonna diminish in importance over time. But the length that you've got your credit cards opened is going to help your score. That's a 15% item. The one that we hear about the most is people that, well, don't run my credit because it's going to hurt my score. Well, that's the smallest. Inquiries do have an effect on your score, but it's only 10%. So figure if you've got a 500-point spread on your FICO score, say 350 to 850, 10% is 50 points. You went from 850 to 800, you've got a great score. So that's not the biggest one to worry about. But if you want to know what your real FICO score is, you can get it for $1. You go to cleanall3.com, cleanall3.com, and you can get your legitimate FICO score. You have to go and opt out of it after you get your scores and whatnot, because that is one of the tools that you can use to monitor your credit. Credit mix is also 10%. How much revolving debt do you have? That's credit cards. How much installment debt do you have? That's mortgages and auto loans and other fixed rate loans that you might have. So that's 10% of your score. Next, consumer scores versus mortgage scores. So what is a consumer score? And again, this is kind of what I talked about just a minute ago. It's the Vantage score, the Credit Sesame score, the Credit Karma score. They've got different models as well. They've got Vantage 1, Vantage 2, Vantage 3, Vantage 4. So you'll know when you're looking at scores, there's a difference between even going to the FICO score. There's a difference between a FICO score for mortgage, a FICO score for auto, and a FICO score for credit. There's a different scoring algorithm for each of those. So the Vantage credit score, most credit monitoring services, again, Credit Karma, Credit Sesame use Vantage 3.0. Scores range from 3 to 850 to mimic FICO, but they're not the same scoring model. Look at that, where you've got that payment history is 40%, age 21%. You've got the credit used, you've got balances, credit behavior, that one wasn't even on the last one, credit available, 3%. That's all your Vantage score numbers right there. Again, FICO versus Vantage, there's the two different models to give you an idea of what they look like and what they're plugging in, what the algorithms are using. Now, if you've got insomnia, or if you're kind of crazy like me, you reading a credit report, again, as a lender, we have to understand all of this stuff, and we do it. We just try to give you a high level so you've got some background. The bottom line on all of these things, we're going to give you enough information to give you the background and enough information to say, hey, give a call to Ron and his team. They understand this. They'll go over it with you in depth. I don't know too many real estate professionals. You know, the ones that do lending and real estate, they'll be getting reports like this. But for the most part, the realtors, they're not getting into this. They don't want to. So the best thing to do here is just have your clients give us a call and let us deal with this right from the very beginning. I, in fact, had this exact scenario yesterday. An agent I work with out in Palm Desert, he said, here's the guy, his credit scores are low. Call him and tell me when he's pre-approved and for how much. And then the agent is done with it. He's going out to do exactly what his job is. And as I've shared with you many, many times, the realtor's job is quite simply prospect and convert. Prospect and convert. Once they're converted, you're going to have your lending team, your lending partners like us, take care of that part of it for you. Let your transaction coordinator take care of the transaction portions, and you're going out to find the next transaction. More personal information is that employer is going to be on there as well. I've got these pictures, the participants on here. Aliases, that's another one that shows up on there. So what is aliases? Well, my legal name is Ronald Siegel. Alias would be Ron Siegel. So that's where your aliases come in. And you want to make sure that they're correct. So that what if the question will become up on there is what other names might you be known by? So all of those are going to be found on generally the very front of the credit report or towards the back right after the account information stops. So that's going to be on one end or the other. So here's actually what a CoreLogic Credco report looks like. And you can see all the different information that's on there. This is the instant merge report. One of the things you should also be aware of is even though you're looking at a credit report, so if I run a credit report right now for the benefit, say Johnny has a client, he wants me to run a credit report, and I've got all the authorizations for the consumer and I run the credit report. And an hour later, that client goes into Bank of America to get their credit run. The credit scores may not be the exact same as when I ran them. There could be some differences. Something might have reported in the interim. So there you could end up seeing differences just from hour to hour. It's kind of like the stock market. It changes all the time. So you're going to actually see in there where I just put the arrow, the person's name. You can see their current address. And again, if these things are not correct, they need to be corrected. Their social security number, date of birth. You're going to see if there's any warnings on there on the credit code. They put it right here. So there's a fraud alert or any kind of warnings that the bureaus have. You might even have a frozen account in there. You're going to see the delinquencies down there. Number 9 is if they've got a history. So that's giving us, that's a real a summary right there. So you've got real estate, how many 30, 60, 90-day lates do you have? Installment loans, revolving. So this particular one had 2 30-day lates on there. And that was all their negatives that were on that particular items. So here's the trade lines. And again, you can see where the arrow is. That's going to be the data source. You've got Equifax, Experian, TransUnion that are reporting those different. So there's the scores for each on that. You can see the scores over there at number 13 will actually give you the scores. And I don't know why I got the headscan in the wrong. So under applicant notifier, that's going to tell us whose trade line that is or who that's for. So this happens to be applicant 1 for those scores. If it was the co-borrower, it's a applicant 2. When we're looking at credit scoring, it's not an average of the 3 bureaus. It's the middle score. So you can see here, this particular borrower has a 765, or you can tell it's a fake borrower because the name is Testco. So the first score for Equifax is 765, Experian is 706, and TransUnion is 692. All we do is look and say which one is the middle. So 706 is in the middle. If we only have 2, we take the lower of the 2. So that's where that's coming from. It's not an average. It's really right there in the middle of the scoring numbers. Throw out the high and the low, and we just grab and go. So these are actually the trade lines for this individual or this report. And this one actually is going to be a joint, a 2 people on this report. You can tell that by looking over there on the far left where it says ECOA, whose is the account, who is it? So that's a joint account on there. Obviously we've blacked out the account number. So you can see, and here's areas where we're looking to see when we're looking at doing credit corrections, when we're counseling people on credit corrections, we're looking to see over there in the months reviewed over there toward the right, how many months has it been? So this one says 5 months reviewed on a card that was on a report. The trade line was started in 2015. The date of last activity was September of 2015. So we're looking to see, does that tie in with the current amount of months that we are from the time that was opened? So you can see, to me, I just look at this and see there's got to be some sort of discrepancy, because that Barclays shows that it's got 21 months reviewed, and that was opened in 2014, and the one right above it was opened in 2015 and only has 5 months reviewed. Last time I checked, there was about 12 months in each year. So we're wondering why isn't there more on one of those than because I don't know what date this report is. I don't have that right in front of me. And why is that important? If you remember at the beginning, I told you that history accounts for 35% of the FICO score. So if that 5 months of review time should have been closer to 20 months, well, that's going to have an effect on someone's FICO score because it's giving them more history. And you can see down there that Chase card has 1 30-day late. So you want to find out why. And sometimes you can get that corrected. Sometimes you don't need to worry about it if it's old enough. Sometimes you can ask for a courtesy removal. You can ask Chase to say, this person's got, well, you look at that one, it's got 99 months reviewed. That's the max. So that says 99 months reviewed. They've got 1 late. So Chase might be willing to go and take that off of their report because of the way that's reporting on there. So again, you can see tells us, is it the borrower's trade line? Is it a joint? Might even say an A in there for an authorized user. You can see that where those circles are. So what's the code for that? So the ECOA letters are B for borrower, C for co-borrower, J for joint, A is for the authorized user. Let's see, the borrower 1, co-borrower 8, joint 2. Those are some when you're looking at the numeric codes. So we'll get into some of those as well. And we're always looking, all these different things come up when everything is, because of the way the automation, everything is brought to codes that when the information comes over from the lender, it comes into the bureau and they're going to assign a code to everything. So that's why you're looking at those ECOA codes and the WHOIS code, the MOV codes. They're looking at all those and putting in there what those different codes are. And that's why at one time it doesn't, I think they changed it a little bit, but it used to be that a parking ticket that went to collection had the same weight on a FICO report as a bankruptcy because they didn't have a separate code for the two of them. They basically just both went in as a public record or collection section. So it's kind of interesting how that happened for a long time. So you can see there the date reported. You want to make sure that that's accurate. And again, that's all information for the going into the models. The date the card was opened, again, that's going to go into our history, giving us that information there. Date last activity. So here's one of the things I share all the time. If the card is not active over time, it's going to have less and less impact on someone's FICO scores. So with that being said, make sure your cards are always active. How do you do that? Well, you look and you say, which of my fixed expenses do not charge me to pay them with a credit card? So for instance, Verizon does not charge me to pay my Verizon bill with a credit card. So I have my Verizon bill automatically go to my credit card, and I have my bank account on auto pay for the approximate amount of my Verizon bill. So now my Verizon bill is always going to be in use, so it doesn't go as dormant, so it stays as an active on my bureaus, and I don't have to worry about paying it because I set up an auto pay with my bank, so they're paying the whole thing. You can do that with your Verizon bill. You can do that with your, I think gas bills take it. Anaheim Utilities does not. They charge an extra fee. I'm not sure about Southern California Edison. You might have it for DirecTV or your streaming services. Those are all different things where you can have a different credit card for every one of those services. And if you use those and put them on auto pay with your bank, you're going to keep them active. You're going to keep your utilization low, and you're not going to have to worry because you're always making that payment anyway. So you can see there the date last activity, and you can see, well, the corresponding on that Capital One card, the date last activity on that one was August of 2015. High credit limits, that's going to be right there that we just circled. And again, that's going to be used for the utilization numbers. High credit limit indicates the total in there. And again, the screen is in the way. So total amount of credit that the client is being extended to the highest dollar amount that's ever been charged. So if you've got a credit card, say like on that Barclays card, you may have a limit of 4,700, but maybe you went over at one time and it was at 4,900. So they'll put the high balance in there as well. And they put in there, you notice there that it says that the minimum payment is $127. That's going to be an important number for a lender to use when we're figuring out the debt to income ratios. Account type, again, you can see that you've got auto, you've got revolving. Auto is the same as installment. Revolving. So what type of loan is it? We're going to look and see if it's a mortgage loan. It could be a home equity line of credit. Again, revolving or installment. payment terms. So again, you got the balance and you've got the terms. And you've got whether it's past due and the how many times past due. Those are all going to be parts of that payment history again. Balance indicates how much was owed at the last report by the creditor. Again, that's why when you look at that rsrccpayment.com, very important, pay your credit card bill the most. You're going to pay twice a month. Some people say, well, paying twice a month doesn't benefit, Ron. Well, it's not the fact that you're paying twice a month. It's when you're making your payments. So you want to make the biggest payment you can afford right before the statement closing date. That way, when they report, generally most of your credit cards are going to report at the statement closing date. So if your statement closes, say on the 17th of November or the 17th of the month, they're going to report that date. You want to make sure that you made your biggest payment possible so that it posted yesterday. That's one payment. Now, you may have transactions that didn't get through and they show up on the report. So maybe you say, well, I pay my credit card in full every month. So you made that payment. It got there, say on the 15th, on the 16th, you made a charge. It shows up on your bill on the 17th. Well, the second payment that you want to be making is make sure that you're always making a minimum payment right before the payment due date. So that's why you have a higher score when you have two payments. It's not the fact of making two payments that got you the higher score. It's the fact of when you made those two payments that got you the higher score. So that's the whole issue on that part of it. So the codes that are in here, all these different codes are telling the algorithms something new about the report. And so you're always wanting to watch those. And again, we've got charts and models of all those different things that tell you the method of payment. And again, that's going to tell you the current status of the account. There's the coding. Revolving, installment, open, mortgage. There's going to be a letter and a combination number. So you're going to see M1. So there's all of your different manner of payment. So paid as agreed. Again, the scoring models don't see when they put it in the algorithm, they can't read 30 to 59 days. So that's why you've got an M1 or you've got an M30 or 59 or whatever the number is. So what is a collection? Filed with the credit reporting agency. A debt that goes delinquent, no repayment has been agreed upon in place of the original agreement. A collection should be reported as an MOP9 rating. Collection is satisfied by a third party. The original lender has sold the debt to a third party agency or collection borrower. Again, sometimes you'll see that the debt is sold over and over again. So you may have the same debt on your credit report more than one time. So we want to make sure that that's cleaned off of there. Duplicates can hurt you. So what is a charge off? Do you still owe the money? Yes, you owe the money. But what's happened is the creditor has said, we don't think we're going to get it. It doesn't mean that the creditor has given up. It's just written off so that they're not paying it as income and they can show it as an expense. It's a debt is gone to collection, delinquent status, but it's still being collected on by the original creditor. That's the charge off. Statute of limitations. We're not giving any legal advice here, but it's basically the time that somebody can go after the debtor to get their money back. Statute of limitations on a debt puts a time limit on the amount of time a creditor can collect on the debt. Statute of limitations begins the date an account becomes delinquent. The time frame is based on state law. Every state has their own. California, again, no legal advice, 4 years. Applying for credit. How long does the information stay on your credit report? That's always a big question. And if you want a chart, I can send this to you. I can send you a chart that has some of these different issues. Good accounts stay for 10 years from the date of the last activity. Bad accounts are generally 7 years. Chapter 7 bankruptcy is 10 years from the file date. 13 bankruptcy is 7 years from the file date. Judgments don't appear anymore. Paid and unpaid tax liens don't appear. That does not mean you don't owe them, and it does not mean that we will not find them, because there are LexisNexis reports, there are Fraud Guard reports that will show these things. So it's very important that you let your lender know. There are questions at the end of the loan application that ask about these. Do not lie, we will find out. Hard inquiries stay for 2 years. That's why I said you can use that cleanall3.com. For $1, you can get the same information that shows up on a hard inquiry, but it's a soft inquiry because it's you that's getting it, you that's doing it. So how does shopping affect your scores? Because a lot of people say, well, I don't want you to run my credit because it's going to hurt my score. Remember, it's still only that 10% that I told you, but consumers have 30 days to shop for a mortgage, and it's only going to count as one hard inquiry. Lenders can check it. They feel that's prudent for you to be looking for who's got the best opportunity for you. As I've shared many, many times, as a mortgage banker, we actually work as your private shopper. We're going and shopping to many, many different sources all across the land, because it's our job to say, well, this week bank 1 wants self-employed people and this week bank 2 doesn't. So bank 1's going to have better pricing. If you go into a big bank on the corner, they only know what they have to offer. Consumer Financial Protection Bureau, the CFPB, and FICO. CFPB says 45 days, but FICO says 30 days. So again, those are like kind of like overlays. You get the law, and then you get what you can do that's enhances what the law says. Will a mortgage credit check drop a score? Not for 45 days. Again, we can do that shopping. And if you do, it's only going to be a few points. It's not going to have a major issue on your credit scores. Credit and your mortgage. What does lender look for on the credit report? Everything. So basically what we're trying to find out is not only do you have enough, we can look at your bank statement and see if you have enough money, but we have to look at your credit report to see if you're willing to part with it. That's basically the information you're finding on there. How well you repay your debts is the bottom line of what that's all about. And how does the credit affect your rate? Well, it's going to have a significant effect on your rates. If you qualify, it's also going to be what's going to determine whether you qualify or not. So the lower the credit score, the higher the interest rate. The higher the credit score, the lower the interest rate. I looked at a $400,000 loan just recently, just to see for the numbers. 650, the difference between a 650 and a 720 FICO was $236 a month. So that's a big issue right there. Conventional loans, 620 credit score is going to be the bottom. FHA loans go down to 580. Again, there's other factors that go into it. The FHA has 3.5% down. You can go down to 500 if it's got 10% down on that FHA loan. The VA loan goes down to 580 credit score. There might be some exceptions in there. Again, it depends on the lender. You might have a lender that says, well, I'm not going to do any conventional loans under 660 or 680. Lenders have that authority to do that. They just can't go, they can't go to, say, on an FHA, they couldn't go to 490, or they couldn't go to 500 with 3.5% down, but they might say, we're only going to do 3.5% down on a 620. What are the wait periods for derogatory items? And again, if you want a chart on this, I've got it. So there's what the chart looks like. We've got a whole derogatory chart that kind of gives you foreclosures, bankruptcies, short sales. Let us know if you want that. You can either put it in chat or send us a note, rj@ronsiegelradio.com, or you can text us at the same place where we sent you the reminders for this here. Again, conventional loans, you got foreclosures, a 7-year waiting period, bankruptcies. Chapter 7 is 4 years. Chapter 13 is 2 years. Sometimes there's extenuating circumstances. Short sales are 4 years from the completion. And you can see all the rest of them. I'm not going to read the whole chart to you, but you can see for FHA, there's their guidelines. VA has their guidelines. USDA has their guidelines. And again, there are exceptions to everything. How do you improve your credit score? Well, so here's some of the myths that are in the credit score. That carrying a card balance is going to improve your score. There's only one credit score. That's another myth. Closing your old credit cards can boost your score. No. Co-signing on a loan won't affect your score. That's wrong too. It will affect your score. Paying off collection and other debts removes it from your credit report. No, it doesn't. And if it's a older collection, unless you get in writing that they're going to remove it from your credit report, Paying off an old collection actually can be detrimental to your score because it re-ages it. Paying your credit card off each month hurts your score. No, it doesn't, but it might not help either. Again, as I told you before, you got to pay it the right way. rsrccpayment.com. Things that boost your credit score, leaving your accounts open, paying your bills on time. These are all pretty obvious items that are going to help you move that needle from the 300 to the 800, which is what we really want to do. Action steps to improve your credit. Pay the credit card balances down and pay them the right way. Pay any past due accounts as soon as possible. Don't close credit accounts, especially the older ones. Keep those open. Pay your bills on time. I've seen 30-day lates cost somebody 100 points. Add revolving charge accounts. You can do that strategically if you're not looking to buy anything, a car or a house. You can put on more cards because that helps your utilization. Getting an increased credit limit, but not spending more money. That'll help your credit scores because, again, that deals with your credit utilization numbers. Tools to build your credit. If you don't have any credit, a secured credit card can help. So that's where you're basically paying up front for the credit card, and you're going to make those payments. Again, you've got to use the right secured cards. If you use the wrong ones, it doesn't help because not all of them report. If you need credit repair help, give us a call, 800-306-1990. Couple of different options right there. You can do your own credit report. For anybody that's on the call in the rest of this month, we're actually going to do a free credit report audit. If you go to cleanall3.com, get the $1 credit report, send us their credentials for that, your username and password. We'll put that along with a little bit of other information into our platform, and we'll generate a 13-page or 15-page credit report audit, and we'll go over it with you. We'll tell you what you can do to fix your report. You don't need a credit repair company to help you with it. You can do everything on your own. You may not have the tenacity to stick with it that the credit repair companies will, but all of it can be done by you. And we're actually going to be coming out with a book this weekend. We're going to finish it and get it online that you can actually buy a do-it-yourself book. And I think it's only going to be like $29 or something like that. As always, I share with you that I don't do public speaking. I don't get paid for public speaking. I get paid as a lender. We want to apply for the job as your lending partner. That's how we make our money. Call us 800-306-1990. Again, the biggest thing is if you want to understand this really well, again, I've been doing this for decades and decades. All you really need to know is the 30,000 foot level of this. Can your credit be repaired? Yes. Can you increase your credit scores? Yes. Are there ways to get you approved for a loan on a game plan? Yes. How do you do it? Call us, call our team. That's all there is to it. Are there any questions, Josh? Anybody have any questions that we haven't got to?
No, there's no questions in the chat at all.
Okay, if you have questions afterwards, feel free to call us anytime. We hope you got some value out of it. And again, hopefully we can be your lending partner or your lender if you're actually shopping yourself. And wish you all a very, very great Thanksgiving. Remember, go to rsrseminar.com, rsrseminar.com. 2 weeks, we're going to be doing the same type of an event for building a business plan for realtors. 2 weeks after that, we're going to help you with your marketing plan for realtors. And then right after the first of the year, we're going to do video marketing for realtors. So if there's no questions, I appreciate you being here. And again, give us a call at any time for any of your lending needs.